With most of the big tech earnings behind us, concentration risk is starting to weigh on investors' minds once again. So how should they position now? Joining me now is Bruce Lavine, Astoria advisor, COO, and head of ETFs, along with Todd Rosenbluth, VettaFi head of research. Let's start off with the appetite for equal weight. Todd, we saw another strong month of inflows in July with investors sticking with big tech. You say investors should be diversifying. Bruce, you're working on a novel approach that could help investors with diversifying plus a tax benefit. So Bruce, how does Astoria's large cap fund stand out?
So the idea behind a 351 fund is that you have a lot of stocks that get stuck from a tax perspective because they're up so much. Think about buying NVIDIA 2 years ago. Perhaps you bought Microsoft 10 years ago. And so with the 351 fund, you can only at the launch of an ETF, you can transfer some of these securities into the fund and you'll get back shares in the ETF. And what you kind of transfer in is a basket unique to you that has some diversification as required by the law, but perhaps different diversification or less diversification than you're going to get when you get our fund back. Our fund will be a quantitatively managed active strategy designed to track the S&P 500. So, for a portfolio, let's say that has, 30% NVIDIA, you're going to get back a portfolio that maybe has, somewhere between 5 and 7% NVIDIA or something like that. So a very interesting tax tool for investors, and these are becoming quite popular. We have a fund, the ticker is LCOR, LCOR for large core, and we're launching it on October 1st, and we're seeing a lot of interest in it.
Todd, why do you think investors should consider one of these funds, especially given, the tax benefits, the diversification element? I mean, is this the best way to get that kind of exposure?
Well, there's lots of ways to get exposure to diversification and tax benefits. So ETFs in general are a tax efficient vehicle, so you don't pay capital gains unless you're buying and selling. So this is really focused for people who have a concentrated individual stock position and want to move that in instead of buying an ETF and holding it necessarily the same way. So what we've seen is that investors have been rotating and gravitating towards equally weighted ETFs. So Invesco has the S&P 500 equal weight ETF, RSP. Goldman Sachs has an ETF, GSEW, that's also equally weighted. You spread the 500 largest companies around for diversification. And we're also seeing people turn to more fundamentally focused ETFs that get the diversification because it owns some companies based on what fits into the portfolio. So Victory Shares, for example, has a free cash flow growth ETF, GFLW or GFlow, that is fundamentally focused, strong free cash flow and growth characteristics. You get diversification through that in a relatively new ETF format.
So Bruce, given that we've seen just in some ways and at some points in time, historical levels of concentration for the S&P 500 and certain Mag 7 names, how does this strategy become more popular in light of all of that? As Todd mentioned, you move, say, an NVIDIA, which has run up a bunch, into one of these strategies, don't need to worry as much about capital gains taxes and the like. Is that kind of element of the market the key here?
Yeah, I think of this as one tool in your tax toolkit, right? There are many others. There are ways to harvest losses. There are various things to do. But this one's unique because, on October 1st, if you join our fund, we're gonna solve your problem. And so I think the tech concentration you're referring to has really been the trigger for the popularity of the 351 fund. And we see it continuing. And now that the education is out there, people are using it for different reasons. Again, if they're overweight company stock, they might want to diversify. If they have legacy positions from years ago in a separately managed account that maybe don't reflect tomorrow's economy, they might want to swap out of those with no taxation and into our fund. So there's a lot of reasons we're finding that people are intrigued by this. They just really didn't know it's available. People are familiar with a 1031 in real estate. That rings true for a lot of people. This is sort of got a lot of similarities to that from the stock side.